I'm not trying to beat the market. I'm trying to retire from it one SPY trade at a time. Yo, what is going on, premium chasers? I hope you are having an absolutely God blessed day. Today, every single person is going to get my brand new ebook where I'm going to show you, number one, my favorite screening software for tracking my options, and number two, all of my favorite settings for that screening tool. So if you want that, that's going to be super helpful for you option sellers. Drop a comment down below and I'll make sure to send that over to you. But guys, today we're going to be talking about the whole retire early, how to retire, how to make some sort of active income during retirement. Now, I'm going to assume if you're somebody that has at least like $600,000, right? I would imagine most people will have that in their retirement years, but you don't want to be like pooling that money, right? To me, that kind of scares the crap out of me, right? If I have like a couple $1,000,000 and I got to just live off what I got left, instead, I want to be able to actually create some sort of active income. I'm going to show you guys a really cool strategy that I like to call the ARC option strategy, but essentially it's an over-engineered wheel strategy. So let's dive into it. The example we're going to be using today is SPY. Why do I like to sell options on SPY? Well, if I just zoom out to all time for SPY, we can see for the most part, SPY has always hit all-time highs. Now, obviously, results vary, not financial advice, right? Past performance is not indicative of future results, but it helps me sleep a little bit better at night knowing when I look historically, SPY has always hit an all-time high. Now, with that said, right, the biggest risk of the wheel strategy typically is missed out opportunity, right? Upside, right? Like if you are running your covered call, right, and it shoots way above your strike price, you miss out on all those gains. And then on the flip side of it, with your cash secured puts, if it tanks on you and you end up buying it for way higher than market value, right? Which, okay, like that's the reality that happens when you're in this game, right? It's part of the wheel strategy. It's part of the risk, right? There is no such thing as free premiums or free money. However, like I said, if I get stuck holding SPY, I'm going to sleep a little bit better at night because I feel like it's going to recover and hit all-time highs again. Again, we don't know that for sure, but it helps me sleep better at night. So let me show you what I'm talking about running this. All right, so I'm over here just using Robinhood for example. I'm going to go to the trade options. I'm going to sell a put, and I'm just going to go 7 days out to the July 10th expiration. So I'm just going to go 7 days out for this example. Me personally, when I'm running SPY, I like to do weeklies on SPY. That's just the way I like to do it. All right. So I'm just going to show you guys real quickly. Right. So firstly, right, we are now saying we're willing to buy 100 shares of SPY in 7 days from now for a price that we choose, right? Obviously, we want to get it better than what it's currently trading for. Current market value of SPY is $623. And you can see on the left-hand side, these are all the strikes that we could maybe be assigned and purchase 100 shares of SPY. So if I scroll down here, right, and I'm just looking, let's say 615s, we'll click open into the 615s. We can see the delta is a 0.21, which for caveman people like me out there, that basically is just the probability of assignment, right? So there's a 21% chance that SPY will be 615 in 7 days from now, and you will have to buy those 100 shares, right? Or the way I like to look at it is an 80% chance of it expiring worthless. Is that the technical definition? Absolutely not. Is it the way I like to explain it to myself? Yes, it is, right? So with that said, what kind of deltas do we want to target? Well, that's going to depend on your risk tolerance. For me, I like to be a little bit more aggressive when I'm doing SPY. Typically on individual stocks, I like to be between a 0.20, 0.30 delta. That gives me a good mixture of being assigned and just expiring worthless, okay? However, when I'm doing a SPY weekly, I'm a little bit more aggressive because I'm not too worried about it, right? I'm not too worried about, getting assigned SPY. Like I'm genuinely not. Like worst case, I'm holding SPY for a month, 2 months before I can run covered calls on it again. Again, that's just me. You're going to have to go make your decisions for yourself. So I'll go up a little bit higher. I'll go 620s. And we can see the delta is a 0.35. And that's actually where I like to be. I like to be in that 0.35 to almost like a 0.40 delta on a weekly SPY wheel, okay? So we can see here when we click into it, we see a lot more other Greek information. I love doing SPY because the spreads are always really tight on this. And the premiums are okay. They're not an insane ROI on your collateral, but that's not the play here, at least in my opinion, right? The ROI on collateral is I kind of look more more so for individual stocks. For the SPY wheel, I'm more focused on just like income generation, right? And capital preservation. I'm not trying to go and YOLO into crazy stuff. Again, the worst case scenario in this situation, right, for me at least, is getting assigned SPY and having to hold on to it for a few months, which to me isn't a big deal at all. So you could see right here, I'm collecting $255 or $256, we'll just say $256 of premium if I open up this contract. Now remember, a single contract is always equal to 100 shares. So I'm gonna go toss this into my cash secured put calculator. All my calculators, guys, are completely for free. Join us. They're inside our Facebook group. The link will be in the description. Join our Facebook group, introduce yourself. It's a really fun, a fun group of people in there, and all these tools and stuff are there for you to actually go use. So I'm collecting $256. That's given to me as premium from an options buyer on the other end immediately when I open this position. Now I'm going to have to lock up a good amount of cash, right? How much cash? Well, if I just did one contract, I would lock up $62,000. Remember, one options contract is equal to 100 shares, so 620 times 100, we got it, $62,000. So I'm locking up $62,000 for 7 days, okay? I'm locking that up for 7 days. My return on my collateral, which is my premium divided by the collateral that's being locked up, is 0.41. Not really good, right? No, not really good. But again, I'm not looking at this in a perspective or ROI on collateral like I do individual stocks. I treat ETFs a lot different. This is a more, in my opinion, for me, a more safer play. Again, I don't mind holding SPY if I have to end up holding SPY, right? Like I just don't mind it, okay? So we can obviously open as many contracts as we want. Let's see how much we can actually get away with here. Let's just do 5 here because I'm just terrible at math. Oh, we can actually get away with 10. Let's do 10 for the sake of it. So $620,000 in collateral, right? We would lock up. And let's say we did 10 contracts, we would collect $2,560. Now, obviously, not financial advice. These premiums are only at the time of me recording this video. The premiums are constantly changing as you're seeing on your screen. It's 258 now, and then it just continues 259, and it's constantly changing, right? So results vary, right? Read the disclaimer, right? These are constantly changing. But this would be if we had $620,000 and we wanted to kind of like, I kind of look at it as like writing ourselves a paycheck in a way, right? We're collecting that in a week. Now, let's talk about the risks. We got to talk about the risks. What are the risks here? Because, to you might be like, this is amazing. To me, it is amazing because I plan to do this even more heavily than I am doing now in my retirement years. Because like for me, I don't know any source of way to make money. Like I genuinely, I say this, I don't know any other way that I can make money purely passively at this level without actually like doing a side hustle or working. Now, of course, there's the argument for T-bills, high yield savings account, sure, but they're not as obviously as juicy as doing something like the wheel strategy or the ARC option strategy. Now, here's the cool part. Robinhood is awful, right? So you're actually not even collecting interest on this collateral. I primarily use Fidelity. You guys know we have a public portfolio here on the channel. It's only $5,000 that I document my trades. But when I'm locking up this collateral, I'm not earning interest with Robinhood, right? With Fidelity, passively, I am earning interest on this money. I'm earning interest and getting paid out monthly on this collateral that's being held, right? And that's why I kind of over-engineered the wheel strategy for myself because I don't trade a lot, right? A few times a month, if that. And so I need to over-engineer it to pick up all them peanuts, all the cash that I possibly can along the way. And one of those ways is right here, right? We're collecting the premium, but then we're also collecting interest on our collateral as well, right? Which at the, last time I checked, Fidelity was giving about a 3.93% a year, which, hey, that with this kind of collateral, that adds up really, really quickly. So, but let's talk about the risks and what can actually happen here. So let's say 7 days from now, right? The 10th rolls around and SPY is trading sideways. Let's just say it's at 624. It's just 623. It's just been trading sideways. Well, if that happens, right, your contract or contracts, however many you opened up, would expire, right? Your $620,000 or $62,000, let's just say for the sake of this simplicity, would be given back to you because it's collateralized, right? Your brokerage isn't going to let you just say you could buy 100 shares of something and you don't have the money to back it up. It's going to use your cash or or it's going to use your margin. You want to use cash, right? Because you're going to earn interest on that if you're using like Fidelity or Schwab, okay? Can't stress it enough, guys. It's bonkers for, I went so many years without really, earning interest on my collateral. And it, honestly, it literally is burning money. It's literally just burning money or just, your collateral will be returned back to you to then run the play for the following week. That's it. That's fantastic, right? The second thing that can happen is, let's say SPY has a big pullback. Let's say it drops down to 615. Well, you're on the hook to buy your shares at $620, right? Let's say it drops to $500. Let's say something insane happens in the world and the stock market just absolutely plummets. It plummets to $500. Well, you're buying your shares at $620 per share. So you got to weigh those risks out for yourself. Can't stress it enough. But let's just assume you did get assigned and it was at, let's say next week, SPY is trading at $615, right? And you got assigned at 620. Well, what can we actually do now? Well, now we'd go back onto our chain, right? Our money, our $62,000, we'll just say, was taken from our account. We're given 100 shares of SPY, right? With our cost basis of $615 or $620. And what we will do now is, instead of selling a put, we're clicking sell a call. Now what we're saying is we're willing to sell our 100 shares of SPY that we have for a price that we choose, and you guessed it, collect some more premium from the options buyer on the other end. All right. So for the sake of this video, so the appreciation sale doesn't look all insane, let's just say you bought 100 shares for $623, because I don't want the I don't want the crazy people in the comments being like, Pete, but the premiums wouldn't be as nice or the appreciation wouldn't be as nice. So I'm just going to assume you own 100 shares of SPY at current market value of 623. Okay, is that fair? Perfect. All right. So now that I have that, right, I'm going to come over to my option chain. I'm going to start clicking into some of the contracts and seeing, hey, where is my 0.35-ish, 0.40 delta, right? So I see this 628 right here, about 210 in premium. I see the 627s here. It's a 0.40. So there's no real perfect 0.35 for me. So for me, what I would do here is I'd most likely go for the 628 because that's already just at that under that 0.35 where I want to be, and I have $213 of premium, actually $229. So this thing is just, again, it obviously I'm doing this when the market's over. We're just gonna say 230 because this thing is moving. All right, so now I'm gonna go to my covered call calculator, again, free in the Facebook group. Join us, it's a vibe in there. Link will be in the description. Let me see if I can zoom in here. Boom. All right, so we're collecting, what do we say, 230 of premium. Our strike of the option, that is the strike that we're willing to sell our shares for, is $628. Right? I got to keep things simple for myself, guys. I can't stress it enough, man. For me, I got to keep things very, very simple. I'm not a full-time trader, guys. So for me, this strategy fits my lifestyle, 3 kids, faith, family, work, business, health, all that stuff that I prioritize over trading, believe it or not. So for me, I love this strategy because it's just easier, right? I don't have to be staring at charts or stressing out or getting my adrenaline pumping. Some of you do get your adrenaline pumping with this strategy because you'll go into MSTR and stuff, but you guys keep doing you. I'm never going to be able to tell you what to do. It works until it doesn't. That's all I'm going to tell you. It works until it doesn't. So what was our purchase strike price? We said our purchase was around $623, right? For our shares current market value, premium return about a 0.37, so similar to what we were at before. Obviously, we would times this by 10, right? So for simple math, so we could show it off because we can't do basic math, $2,300 in premium right here that we would collect if we did our 10 contracts again, right? And obviously, we would also, if we sold our shares, would make $500 profit on the shares, right? Even more, right? So we're collecting $2,300 in premium on the covered call side, but also the profit on the shares on 10 contracts starts getting real nice. All right, starts getting real nice. Obviously, these are numbers I'm seeing on my screen at the time of my recording, but there are risks that let's talk about, okay? So let's say we did do this trade, and then, 7 days roll around, and SPY is just trading sideways at $624. Well, if that's the case, your contracts would expire worthless again. Your shares would be returned back to you because they're not being sold, and guess what? You could run the play for the following week. Bada bing, bada boom, right? Pretty simple, right? The second thing that can happen is you miss out on gains, right? Let's say in a week from now, some crazy good news comes out, right? And SPY is trading at $650, right? Well, you're on the hook to sell your shares at 628. Am I upset about that? Am I upset about that? No, because I locked in real gains. Again, if you're doing this with a $600,000+ portfolio, you're timesing all of these numbers by 10, right? So to me, I'm never going to be upset about locking in gains because I've been burned so many times. Give me an amen if you've been burned many times buying and trading individual stocks, right? Now, obviously with SPY, I kind of minimize that because it's an ETF, right? It's a self-cleansing ETF. So even if I have to bag hold SPY, listen, I don't know anybody that's going to be upset holding SPY compared to individual stocks. If that is you, that's wild to me. So guys, if you want to take this a little bit further, I want to invite you to click the first link in the description of today's video. If you resonated with me at all in this video, you like my teaching style, and you want to join an incredible mastermind of people doing this day in and day out, sharing their wins, sharing their losses, sharing their ideas, and all the training and everything that you need, I want you to check out the Option Seller School. That will be the first link in the description of today's video. There's a short 10-minute video that talks about the ARC option strategy, how we combine 5 powerful sources of income into one really simple option strategy that doesn't really take more than 30 minutes a week of your time, really. So click that first link in the description of today's video, guys. Remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.